Okay, welcome back. There's about 13 minutes to go for market closing. We are down 375 points. Our alpha manager of the day, Trideep Bhattacharya, is Chief Investment Officer, Equities at Edelweiss Asset Management Company. Trideep, great to have you with us here. Thank you very much. It's a big day with the RBI out of the blue coming up with rate increases, the repo, CRR, and of course then in a month's time there'll be more. What do you make of it, and thoughts on what it means for equities from here on?
Yeah, so I think overall, if you look at what's where that basically, there is a bit of an interest rate regime change which is happening globally as well as today. But the fact that and I think when interest rates go up, it acts as a bit of a gravity to stocks. All of these we actually know, and that's kind of in sync with what we, by and large, the first half of this year is going to be fairly volatile.
Trideep, sorry, your signal is coming and going, so we'll just have to fix that. We'll just do that, we promise, in a minute or two, and come right back to you. The market, by the way, is pulling back a little bit, but not by much, right? 395 points, still down. The low on the Nifty is 16,623, and we're at 16,675 right now. I mean, about 50 odd points of the day's low is what we have on the index right now. I mean, who would have thought? In the morning, all the focus, of course, was on what the Fed will do, etc. And RBI, I mean, first, of course, the announcement that there is an announcement coming, and then, of course, rate increases just an hour back. So this has been unexpected in that sense, the quantum and, of course, both the timing, and I think the reaction is for all to see.
And I think Jayesh made a very good point, right? Yeah. The bond market reaction tells you that this was just like the HDFC merger had announced. Yeah. Nobody had a clue.
Nobody had a clue.
And that's also one more reason why RBI is such a respected institution, Prashant, because I think barring perhaps the MPC, nobody would have had the slightest of clue that something this big is coming today. And that conversation would have happened between MPC members online or on phone or whatever. And you have this. Otherwise, the market would not have reacted like this.
Yeah, I mean, they usually get a sniff of things, but not this. So absolutely, take your point. LIC subscription numbers are also at the bottom of the screen. So total has been is about 0.4 times done. Retail 0.5. These are very healthy numbers for an issue this size. I mean, absolutely. Policyholders 1.65. So policyholders more than their share done almost twice over. Employees almost fully done 0.86. And these are numbers till 317. So there is still a few hours to go. What we'll do is we'll take another quick commercial break here. 10 minutes to close. Trideep, of course, is with us, and we'll have him back on to tell us what he's making of the market post the hikes.
Welcome back. The market is still down, down and out actually today. You'll have to say that 2.5% down on the index. In fact, across the indices, it's down 2.5%. So broad-based secular decline is what you have today. Trideep Bhattacharya is with us now on phone line. Trideep, hi, good afternoon. So, your first thoughts on the way the markets reacted to today's surprise announcement from the RBI?
Not surprising, I would say. I think we've been talking about the volatile first half for quite some time in the market. I think basically the market, whether India as well as abroad, is adjusting to the change in interest rate regime. And today, actually, India saw the realignment to that effect, and hence the market is reacting to that. So I'm not surprised at that. In fact, I would say that what you hear from the United States today night will also be a step in this direction, as the market is looking for a gauge as to how far high the interest rate needs to go before they calibrate the inflation correctly. Okay. And I think over the next couple of months, you will see more signs of that happening, and you will see a yo-yo kind of a movement in markets over that period of time.
Got that. Now, Trideep, there are two questions here, right? First is the market extremely oversold heading into the event, which the market is. So the consensus is that perhaps post-event there can be a bit of a rally. But the larger question is that equities as an asset class, is it hitting some kind of a rough pocket after a good run of 2 or 3 years?
The answer in the short term is yes. I think from here on, the key going forward is basically will earnings upgrades resume? And I think as earnings junkies, all of us, we think that the current quarter and the next quarter will probably see the impact of inflation baked into the numbers one way or another. And probably the earnings upgrade will take a bit of a pause in the very short term till about we see the end of June quarter result season, which is the quarter result season ahead of us. Post that basically is something that then we will see how the earnings recovery really starts to happen. At the moment, the markets are dealing with how high is the interest rate needed for it to calibrate the inflation correctly. In that context, my sense is that when I hear some of the corporates talk about over the next couple of years their capex plans, the other, that has not been impacted so far. And that is a positive sign. So barring the very short term, which is the next 3, 4, 5 months, I would still be constructive with regards to the earnings recovery that will stand to happen. Of course, the spoil sport is if there is a policy misstep and we hike interest rates too much too soon.
Fair point. That is something that is not in our control, right, Trideep? So, we do what is in our control, or you do what is in your control. As a portfolio manager, now with the kind of information that's available to you, what would be your portfolio stance?
I think basically our starting position to head into this situation has been, I must admit, favorable, because we, to a certain extent, anticipated this. We have been underweight the high growth stocks, the high PE stocks in our various portfolios. We've been kind of positive on the economic recovery side, which has played out so far so good. And I think we have by and large kind of avoided the high interest rate sensitive. So that's broadly in the right places, and the portfolio is kind of adjusting accordingly the portfolio behaved well to that extent as well. Going forward, I would think that the areas which are extremely rate sensitive would probably take a bit of a backseat, and I think the focus will come back on the high multiple stocks, which will probably see a bit of a pullback on the back of the fact that in India also now a rate hike is starting to happen. Given that we are underweight those, we are all right in terms of our portfolio positioning. But incrementally speaking, we'll be overweight on areas like industrials. We'll kind of take this opportunity to go overweight select lending financials, because we still think that some of those areas sink in well with regard to the economic recovery that we anticipate over the next 2 to 3 years.
Okay, Trideep, we'll leave it there today. Unfortunately, we couldn't get the camera line working, but thanks a lot for joining us.
Thank you very much.
Before we do a recap, Mitesh,